see. Well, Joey, how are you doing this afternoon?
Hey, I'm doing great. Happy to be on.
Absolutely. Thanks so much for taking the time to come on the show. Do you mind giving us a brief bio and some of the big ideas you're interested in?
Sure. My name is Joseph Politano. I'm self-employed, self-described economics expert and data analyst. I write a newsletter called Aprictas on Substack. That's my full-time job, and it has been my full-time job for a whole 2 months now. So I have been writing for about a year and a half, and very recently took the leap to make this my full-time gig. And most of what I focus on online is trying to do data analysis of the macroeconomy with like a special focus on labor markets and the Federal Reserve. Very, very nerdy way to say I do charts about macro and try to keep that as fun as possible.
I love it. Well, I want to get us kicked off and ask you this, and I like my episodes to kind of be timeless and stay on the test of time, but I am curious about the current moment. What is going on with labor markets right now? It seems like we had a strong jobs report again, despite Jay Powell doing everything in his power to jack up rates. What is going on with employment markets at the moment?
A lot. I think it has genuinely been one of the craziest times for global labor markets, and especially labor markets in the U.S. The way I've tried to conceptualize things in sort of a backwards-looking fashion is that most high-income nations, there are some exceptions, most high-income nations had some combination of like a furlough program, or they were really good at blocking the spread of COVID. The
Gotcha.
U.S. had neither of those things. So in the UK, where there was a lot of COVID spread, there was less unemployment because of these furlough schemes. You're keeping people attached to jobs. In the U.S., there was a lot of people who were let go at the onset of COVID. You don't have that strong employment protections, didn't have this furlough scheme. Just was something that was not in the federal government's capacity, period. And so you had this big dispersion of cash to households, especially to households in need at the start of the pandemic. And you had the sort of low rate environment, all of which was necessary to get like employment levels and labor income. I'm a big fan of like looking at total labor income as a big economic indicator to get that back on trend. What that meant is you had a big downward push on growth, and just to get back to trend, you needed like a big upward push on growth. So over the last couple of years, we're sitting here now in March of 2022, we've seen really massive upward push. And by basically the start of this year, start of 2022, the strength of that economic momentum that was necessary to bring the labor market back also caused a lot of inflation. And so the story of 2020, 2021 was fighting like the downturn. The story of 2022 is definitely all about inflation fighting. And you have this very interesting dynamic in my mind where the Fed's been tightening monetary policy since the start of this year. That's definitely manifested in like worse financial conditions, but maybe less bad than people expected. And the worst financial conditions have not really manifested as unemployment. You've seen slowdowns in employment growth. I don't want to like say there was no impact. You've definitely seen big slowdowns in employment growth and a little a slowdown in wage growth, especially at the lower end of the wage distribution. But no rise in unemployment yet. And so the big question that we're sitting at now is like, okay, is employment going to hold up? Is it just a lagging indicator from the rate hikes that have already happened? What's the chance of like a recession in 2023? And we're sitting actually, like if you're looking at some of the big sectors, so like truck transportation, which is usually an early sign because a lot of these are small operations. That's been like stagnant. Like warehousing has been stagnant. A lot of the consumer goods employment has been stagnant, but a lot of other stuff has held up really well. So it's a crazy moment, to say the least.
Where do you think we go from here? Do you think recession is likely in 2023?
I will defer to the like nerdy meta forecasters who say yes. I haven't checked in like a week, but the last time I checked, the like meta forecast was something like 60-70% chance of a recession in 2023 and like 80% chance of sometime before 2024. Those are not fun numbers. I think so far part of the reason, we have seen we've seen like the slowdown manifest less as drops in employment just because there's been so much demand, so much like latent demand for labor. And I think really the chance of a recession, and if a recession happens, the depth of it is going to depend on like, do we see a rise in unemployment? And the other thing I'll say is like, I'm a big don't fight the Fed kind of guy. If the Federal Reserve is saying they want something, they are going to get it most of the time. They right now say that they want like a 1% increase in the unemployment rate. And the forecast, it's not like, it's one of those things where like, we're not saying we want this, but the median forecast is that the unemployment rate should be 1% higher under optimal monetary policy next year. That's functionally a recession.
Got it.
We've never seen that rise in unemployment rate without a recession. So that's the worry. I think, like I said, I think people look at understandably, you say a 60% chance of a recession next year. People are like, oh, that's horrible, which it very much is. I don't want to understate that. But that also means there's a 40% chance that it doesn't happen.
Right.
So, like I said, crazy moment right now.
Still sizable. If a layperson is listening to this podcast and you tell them something like, okay, like the Federal Reserve wants the unemployment rate to go up, it almost sounds like if I told us that to someone on the street, they'd be like, what the heck? These technocrats, they're trying to make my life worse, trying to make more, like, can you just walk through why, that's a good thing at some level?
I don't know if I would say it's a good thing. And if I'm taking off my own personal hat, if I'm saying what would someone at the Federal Reserve say? What they would say is that inflation is really high. Yeah. The only way to get inflation down in the short term is to induce real economic pain. So you're saying there's some level of real growth. You have to reduce that or get it a little bit negative in order for inflation to come down. And a period of lower negative economic growth is going to induce an increase in the unemployment rate. There's a variance between people who view this as incidental. On the Fed, some people will say we're raising rates to slow the economy and that will create unemployment. And there's another side that says we're raising rates to create unemployment, which will lower inflation. It's is it incidental to the target or is it causal to what you're trying to accomplish? There's not I wouldn't say there's a steady 100% agreement on that within the Fed, but there's pretty close agreement that, like I said, there's going to have to be some increase in the unemployment rate. And the bill from what Jerome Powell would say is that the only way you can have a stable, long-run growth in the labor market is to get rid of inflation in the short term. If you just kind of keep pushing the problem off, it's going to require it's you take the small medicine now or you take the big medicine later. I'm not 100% on board with that right now, especially because if you think about it purely from looking at the unemployment rate. Yeah. Right? The unemployment rate was 3.5% in 2019. And I don't know if you were around for 2019, but everybody was freaking out because the Fed was raising rates and people were worried about a recession then, and inflation was low, relatively speaking. So I don't think that 4.5% is necessarily going to, I don't think 3.5% unemployment right now is more inflationary than it was in 2019. I think what they worry about principally is like growth in income and spending, which was really high in 2021 and is like slowing down now. That's what they're kind of focused on.
Gotcha. Makes sense. How would you rate the Fed's response to the pandemic, all things considered?
I think it's obvious, especially in hindsight, that they waited too long to raise rates. I think it's difficult, ex ante, to look at things, and say, how much would they have shifted? If I was in charge of the Fed at the time, I would have made the same mistakes, right? I probably actually would have done even worse than they did. And I think part of it was just has been a lot of chaos. And I think coming off the back of the 2008 recession, which was consistently worse than people had forecast, and the forecasts were bad as they were happening, the MO was we just can't let this repeat no matter what.
Yeah.
And I think it would have been a really difficult sell in August of 2021. The unemployment rate is still elevated. Most people haven't been vaccinated, to say, okay, now we start raising rates.
Right.
Even though that probably would have been about
the right time to do it.
About the right time to do it. Yeah, I think it's also just that things have moved so fast. Normally, the Fed, they have this opportunity where they raise rates a little bit. They watch how the market reacts. They watch how the economy reacts. They could say, this was a little too much, too little, and then they bounce back and forth from there. 2019, as a counter example, they raised rates too much. I think if you asked Jerome Powell, he would agree with you on that sentiment. That's why they backed off in 2019 and started cutting rates again. They were like, okay, this is too much. But the point was that they had 2 years there where they raised rates in 2019. They hit a point where they're like, oh, it's too much. And then they reversed in late 2019 up until early 2020. There was no grand punishment for that misstep.
Right.
Compared to the missteps in 2020, 2021.
That makes sense. I'm curious, how do you feel about nominal GDP targeting? Are you a fan?
I am generally a fan. I think I wouldn't call myself a zealot. So
not a
nominal
GDP
target, right? Not a maxi, but a fan. So nominal GDP targeting, for people who don't know, is this idea there's a gross domestic product is the sum of all output in the economy, basically taking total number of dollars spent. And what you should really be looking at is a growth rate in dollars spent, not a growth rate in prices. Because, if you have 4%, usually the target is 4 or 5%. If you have 4% growth in nominal GDP, you think 2% of that is inflation, 2% of that is productivity. And in a situation where the inflation goes up to 4%, and you're still on NGDP target, you're like, oh, we're fine. It's just, we just had a real economic shock. And in the converse sense, where inflation dips below target, you're saying, oh, NGDP is fine. We just had a productivity boom, or oil prices went down or whatever. I think my disagreements come maybe a little more technically with how you do this in real time. Because the GDP data is it's not the most robust data set as it comes out, just because there's so many things that go into it,
Yeah.
And so Skanda Amarnath, who's a great friend of mine, he works at Employ America, he worked out this framework for looking at gross labor income. So he's saying, okay, we believe that NGDP, total spending, total income in the economy, is what really matters, what the Fed really controls, what they really target, or what they really should target. But wages and labor income are the greatest share of that GDP. It's 60% or so.
Yeah.
And it's the most robust share, compared to profits, imports, exports, government spending, which is all can get really messy really quick. So that's what we should focus on. And I think it's very funny because if you were on an NGDP framework, right, you would have said raise rates in August of 2021. If you were in a gross labor income framework, you would have said what the Fed's doing is basically correct, maybe slightly too loose.
Gotcha.
So gross labor income, basically just back on trend. You're saying like it's 1% above trend, maybe 2% above trend, depending on what measure you use, which is pretty crazy considering now you have like 8% inflation.
Yep.
But it's the viewpoint is the core thing you should be targeting like NGDP, or should you go even narrower and target labor income? And I think the other argument for labor income stuff is just that, like, if you think about hysteresis, so this idea that you can have a short-term damage to the economy that becomes a permanent scar. So someone gets unemployed, and because they're unemployed, they don't, learn on the job. Because they don't learn on the job, now you've permanently reduced their wages.
Gotcha.
Those, hysteresis components, they show up in labor mostly, and they show up a little bit in like investment, but they're really not going to show up in like government spending or like corporate profits.
Gotcha.
So that's my disagreement is more technical than it is conceptual, if that makes sense.
Makes sense. Makes a lot of sense. Can you talk a little bit about hysteresis and this term you throw around a lot, which I've not been super familiar with, which is gross labor income. I really like this term. Can you just talk about what it is and why it's important?
Sure. So I'll start with gross labor income because I think it's the easier one. So the base it's really basic. Nominal gross domestic product is saying take all the spending in an economy and just add it together. Nominal gross labor income is just saying take all the wages and salaries in an economy, add them together. What's the growth rate there? So you're looking at really what's the growth rate in employment and what's the growth rate in wages. Like I said, the conceptual idea of why this is a little more robust is because you think the Fed has more direct control over that like core demand aspect. And you think that core demand aspect has more influence over consumer prices. Most people who are, workers are spending a lion's share of their income. So if their income goes up, their spending goes up. If their income goes down, their spending will go down. And that's almost like a rule of nature in the way that it isn't for other sectors of the economy. And just like I said, in real time, you can look at how wages and salaries are evolving, how employment is evolving, much faster than you can how GDP is evolving. And so the idea of hysteresis is like kind of interesting economic
Success begets
concept.
success.
Right, it's success begets success and failure begets failure. And so if you're thinking about, like, let's think about 2008 with the auto industry.
Yeah.
Right, so you have a downturn, you have all these car companies that go bankrupt. They get rescued by the federal government. You have the bailout package, blah, blah, blah. But fundamentally, like, demand for cars had just crashed because the economy crashed.
Right.
And because demand for cars crashed, you didn't get any investment in, like, new car plants in the United States. And because you didn't get new car plants, you didn't get people trained in, manufacturing assembly for cars in the U.S. You didn't get more engineers. You didn't get all this stuff. And now, 10 years later, if you look at a chart of like U.S. Auto manufacturing output, there's like, it's not just that there's a clear drop, it's that there's like a permanent level shift downwards.
Got it.
And that's what hysteresis is. Some people will talk about this also in the reverse, like the success begets success thing, which is like, maybe solar would maybe be a good example. Like you think you pumped all this investment into, like, especially in Germany, you pumped all this investment into renewables, into like green energy and solar, and that, you push down the experience curve so the costs get cheaper, so you hire more people because it becomes more profitable, so the costs get cheaper again, so your market builds, so people become more enamored with your product, and you've got this like big positive snowball rolling. I think that's rarer in the sense people talk about it less. But I think, in my opinion, just as important.
Gotcha. So you really want to avoid things where if you have there could be problems where you get these bad downward spirals where you can permanently damage, and you want to avoid that kind of permanent damage, especially in the labor market where it's people we're talking about and they have permanent shocks. There's a study I read a while back about people who graduate during a recession, how have these permanent kind of income shifts downward just because they have a harder time finding a job initially.
Yes, exactly. That's hysteresis. That's the best example you can get.
Very cool. I want to move on a little bit now and talk about interest rates. So we recently had on Paul Schmelzing from Yale. Do you know Paul, by any chance?
I don't think I do.
Gotcha.
Unfortunately.
So he's an economic historian. Wrote this really interesting paper I really enjoyed. It's called The Super Secular Decline of Interest Rates.
Oh, okay, yes, I do know his paper.
yeah, absolutely. Do you buy this notion that we are just experiencing this kind of long-run 800-year trend and decline of interest rates with variation, right? So it's noisy, so it's going up right now. But do you think we just face permanent lower interest rate environment where squirrels perhaps always have to pay someone to hold their nuts or something like that? You can't just it's like the national state is not positive interest rates.
This is definitely an area where my thinking is a lot mushier. This is where I am more open to debate. I am not the biggest fan of this idea that we have 800-year decline, secular decline in interest rates. I do buy the 50-year secular decline in interest rates, 50-year long run decline in interest rates. Based off the idea that just, one, you have lower productivity growth in most high-income nations nowadays. Two, the lower and middle-income nations that you had, especially in the 70s, 80s, that had pretty substantial growth, also petering out. Three, the global population growth is lower. So if you think about the very raw idea of more people require more homes and cars and oil, whatever, and that requires capacity investments that put upward strain on real interest rates. So lower populations should ameliorate that, and that you especially have older populations and longer lifespans. So you have this big stretch of time where lots of people in high-income countries are retired for 20 years or 30 years. And they have a big pile of savings that they are drawing down very slowly and conservatively. And all of that puts downward pressure on interest rates. So if you look at it's actually kind of funny in a long-term sense that everybody's panicking about the Fed causing a recession, and the 5-year real interest rate is 1.8%. That's not a lot by historical standards.
Right. Not at all.
But the panicking is not. Again, I'm not trying to disgrace the panicking. The panicking is a little justified. I'm saying that a 1.8% real interest rate can wreck a modern economy just because that's secularly interest rates are pretty low. I will say I think the lesson of the pandemic has been, when there's the market monetarist insight where you're talking about if interest rates are high, usually it means that they were too low in the near past. You have high inflation, now you're trying to fix it.
Right.
And that's the environment that especially the United States is in right now. Interest rates are high primarily because inflation is high, primarily because interest rates were too low in 2021, 2020 maybe. The opposite of the 2009, 2010 thing where interest rates were low because they were too high previously. So we just learned the inverse lesson each time. But I think if you're looking at people, some perspective is if you look at the Austrian century bond. So Austria issues a 100-year bond.
Nice.
which, by the way, greatest deal of all time. They issued that at like 1% interest rates or less. It's ridiculous. But it's like I think if I looked it up right now, it's trading at like 2% right now. So in the euro area, people expect short-term interest rates to be under 2% cumulatively for like the next 98 years.
Wow.
That's really low. And those are nominal rates. So you're thinking the real rate should be somewhere basically at 0 or lower. There are some people who think, so this is like the Goodhart thesis. There's this idea that like, okay, people were getting older, which was, lowering interest rates, but that was mostly because of population decline and mostly because people are having fewer kids. So if you think about dependency ratios, so the ratio of like workers to non-workers, the dependency ratio was going down just because there were much less children. Now it will be going up because there will be much more, older retired people.
Yeah,
that's going to be a positive. That's going to put positive upward pressure on real interest rates. So right now we're in the downward phase, but in like 2030, 2040, we'll be in the upward phase. That's like the only kind of decent counterpoint I've seen to this idea. I don't think I buy it, both because I think like lifespans are getting longer, and because I think just in general we're losing like the productivity growth of places like China as they reach like high income nation status.
Yeah,
and at the core level, I'm not sure I buy the thesis, but like that's the interesting counter thesis I've heard, and it is something where I'm like not 100% in my thinking on.
I love it. Do you have any ideas what happened to TFP growth in 1971? Like what the heck happened and why did it happen? Do you have any thoughts there?
You're not gonna like my
no
answer.
Small questions here.
So TFP, total factor productivity growth, kind of fake.
Nice. Oh, I love this. You got to talk about this.
So the idea is like, okay, you have an input of labor, an input of capital, and you get an output. You want to be able to use units of labor and capital more efficiently to generate units of output. Total factor productivity is really hard to measure in like an optimistic sense, and conceptually it's rough because of the kind of stuff that you're thinking about, like the Cambridge Capital controversy, if you know this, where you're like, okay, the Cambridge Capital controversy in the short version is capital like a thing that you can measure, or is it just a byproduct of like future
I see.
It's just a byproduct of future output of consumption, right? So is a factory valuable as like measured in terms of inputs in steel and concrete, or is it just valuable as a sense that it can produce factory goods that you can then sell, and you're estimating the future value of factory goods? I come down on the factory goods side, right? So you're saying capital is valuable, and really you're measuring its value based on what it can do, not what it's made of. And as a result, when you try to do this, like what's it made of calculation, you end up with a lot of wonky results. So if you look at labor productivity, right? So you're saying just ignore capital, pretend it doesn't exist, pretend it's fake, and say for an hour of work, what does the average person create? That in the United States went up about 2.5% a year consistently through, long run, through recessions, through inflation, through a lot of chaos from like the start of the post-war period in 1950 to 2008. So like that's a story that doesn't stop in 1971.
Got it.
So if you look at labor productivity growth, it's still, increasing at basically the same rate as if you really wouldn't even notice the gap in 1971, except for the recessions that happened in the 1970s. And then you hit 2008, and then it's like drops to 1%-ish. It's like brutal drop. So that's where I think like the discontinuity is. It's like pre-2008, post-2008, not pre-1971, post-1971. And that's also, I think, where the more meaningful distinction is in terms of like the global economy, where people I don't think people in the 1990s were like, wow, what happened to total factor productivity? That's not my interpretation of how people felt in the 90s. That is my interpretation of how people felt in like the 2010s, where like, why does everything feel bad?
Yeah.
And I can't articulate fully why, like, especially people in high-income nations who are saying, my life is worse than my parents, or it's worse than I expected. That's something that I think really is a post-2008 story, not a post-1971 story.
Oh, that's fascinating. This is really fascinating. So I'm curious, what do you think changed post-2008? Was it just like, populations just getting older? Is it something else? Like, what do you think's going on there?
I think the post-2008 story is really like a hysteresis story. Like on the scale of...
It's just like... So it's all the Fed's fault. If they had followed Scott Sumner and like loosened it, you know what I mean, or something. If they'd only targeted nominal GDP, we'd be fine.
I think if you could have gotten nominal GDP growth back on trend, you would feel a lot better about the state of the economy. I think people. I think the Scott Sumner, like the counterpoint to the Scott Sumner thing, and this is like the great. Yeah, like market monetarist versus like bond trader kind of debate, like FinTwit bond trader kind of debate.
Yes.
It's like,
okay,
the Fed controls all these nominal variables. Like I agree, but the bond trader side is like, it's like intermediated by banks and by credit. And when the banking system collapsed in 2008, like. They had to fix the banking system. That was the problem, not what interest rates were. And the other side is, it was interest rates. Right. I think I lean more towards the like FinTwit bond trader side.
Interesting.
I need to come up with a better representative than FinTwit bond traders. We'll say the shadow banking side. So I lean more towards the shadow banking side. Partially just because this was like a global phenomenon. It'd be really weird if everyone suddenly messed up in the exact same way at the exact same time.
Yes, very bizarre.
Usually there's a reason why that happens, and I think part of the reason, exacerbated by some of the bad decisions from an interest rate point of view, was just that like the credit side was totally messed up.
Gotcha.
And like so if you were to drag that productivity chain out further, look at pre-war United States, you see that same kind of productivity dip that doesn't recover in like the 1930s, during the Great Depression.
Gotcha.
And both of those stories are, in my mind, partially about credit systems failing, and also partially about monetary policy being too tight and wrecking the economy because of that. Partially exacerbated by the credit, partially exacerbated by the interest rate side. It's very funny to look back at, like, especially in Europe. Yeah. In like 2011, when Trichet at the European Central Bank was like, "Let's raise interest rates," and you're like, "The unemployment rate's 10%. What are you doing?" Right.
Exactly.
But that was like the logic inside a lot of central banks. That's how they felt about the economy in 2008 or 2008. They were like, "Oh, we'll be at zero for like 3 years, then it'll be fine." That was a big underestimation. On that part.
Kind of missed that. I want to ask more about 1971. And sorry to harp on this.
No, it's interesting.
Okay, cool. I find this infinitely fascinating, and it's part of the inspiration for this podcast. Actually, when I got started on the journey. So, if TMP growth is fake, like total factor productivity, like as a measure is fake. If we buy that, what about like the prices of essential goods that seem to have skyrocketed since the 70s? Like, so I think of like healthcare, education, and housing. Is it just some kind of Baumol effect thing where there's just like we've reached some hard limits on productivity in certain sectors where it's just really hard to kind of automate the string quartet, in person? Or is it something else going on?
So, just to walk back a little bit, the TFP thing. Like I said, I don't want to mean that it's literally fake. I just want to mean that it's like
fraught with peril.
I don't think it's a really good measure.
Gotcha.
It's not the most robust measure, and I think it leads to some misleading conclusions.
Gotcha.
But I think it's just like an interesting debate, both because you can pinpoint a lot of changes that did happen in the real economy, especially around housing and healthcare, to the 1970s, and also that like it's not like countries with significantly better systems for administering these things aren't also struggling. You know, I do think a lot of this is fundamentally like you said, as an economy gets wealthier, people buy more services, they buy less goods as a share of total consumption. And what that means is like, you know, wages are the core input to services. If the productivity in manufacturing is going up so much, you know, you end up having to pay a lot more to pull workers away. Or in a broader sense, you just get this specialized post-industrial economy where most people consume services, they work in the services sector, the price of services goes up because the big, you know, input to the price of services is wages.
Right.
And that's still like a story where, you know, real output is going up. I think it's kind of funny when people are like, yeah, there really hasn't been... has healthcare gotten better in the U.S. since the 1970s? Like, yes.
Clearly.
Yes, in a lot of ways, very much yes.
Yes.
And I don't want to, like, overdo it on that story because I think, especially in healthcare, there's a lot of technological... there's a lot of technological advancement that will show up in higher productivity, better outcomes in the way people, you know, want it to be. But fundamentally... there's a certain limit where you're like, okay, like long-term care requires a certain number of people per patient, and the price of long-term care will go up as wages go up, and wages go up in the long term. So the price of long-term care just can't go down.
Right.
And you'd expect it to occupy a larger share of people's budgets, even to the extent that they're able to afford more of it.
Makes sense.
And I think the land, you know, the housing story is very obviously like peak U.S. housing output was in the 70s. And it was getting annoyingly bad by like 2008, and then it got catastrophically bad after 2008.
Yeah.
That's definitely a story where you could talk about like legal creep, about NIMBYism, about like the post-racial integration efforts to constrain housing production as a method to enforce segregation. All of which makes the housing stuff worse. But also, you know, fundamentally, if wages are going up, there's a limited amount of land. I wonder what's going to happen to the price of land.
Yeah.
So I do think it's one of those things where it's like, to some extent, a natural byproduct of how economies are structured, exacerbated by policy decisions in the U.S.
I see. So that's kind of the answer to the story.
Yeah.
Gotcha. Well, you know, going off of that, what is, you know, if we zoom out, what does the next century look like, do you think, for America? It seems like America is well positioned on the world stage. We have decent fertility, decent demographics compared to a lot of other developed nations. What's your thought on the long run outlook for America?
Yeah, I think I'm still bullish America. I think, you know, not to get all like hoity-toity about it, but it's like if you go abroad and talk to people who live, you know, in the vast majority of places, will talk happily about how much they like the United States, how much they admire like the U.S. institutions, how much they want to move to the United States, how much they view it as like the place to be.
Right.
And I think like with the exception of maybe Canada and Australia, which are functionally just too small to be global players, sorry.
Right.
It is still where it is still like the hegemon, and I don't see things that I don't see a situation that challenges it right now. I think the big question mark is still China. I think it has been a series of big L's for like people who are bullish on Russia over the last like 10 years.
Right.
Unfortunately, for people in Russia, I think people who were worried about China, which I think is a worry if you care a lot about global democratic freedom and rule of law and democracy and all that good stuff. Also, especially over the last year, 2 years, has been a pretty bad situation.
Right.
And so it's like if you're looking at the world as it is now, the U.S. is still the least bad option. And there's that quote somewhere where it's like, I think it's funny because I'm in like the finance world, where especially like when the Russian invasion happened, and the U.S. government froze the Russian central bank assets, and you had all this drama about sanctions and stuff. People were talking about like our country's going to move away from the U.S. dollar.
Right.
It's been a really funny year for that thesis because every major country on planet Earth has been panicking about not having enough dollars.
Yes.
Since February of 2022. That has been the dominant theme of like worrying about your exchange rate compared to the dollar, worried about how your economy compares to the dollar, raising interest rates so you catch up with the Federal Reserve has been like the number one theme. And people are much less concerned about, what the rise of China means for this and that. I think it's also, maybe like the 2015, 2016 era of like peak international PR for China.
Yeah.
Where you look at like the Belt and Road investments are down a ton, or like Chinese foreign investment down a ton. And just general people, global opinion of China is down a ton.
Yes.
So, yeah, it's like I said, the least, comparatively least bad option. I am like bullish India.
Nice.
In the sense that I'm like optimistic about the long run trends in growth there, by pure fact of population.
Right.
They're probably going to pass the U.S. in GDP sometime. But I think that's still a long ways away. And, India's, much more free, much more democratic country, although, I'm not the biggest fan of like the regression towards authoritarianism over the last few years. Compared to most countries on planet Earth,
right,
is free, democratic. And so I don't, really worry about it, except in the same sense that I worry about like the United States' political institutions being subject to failure and undemocratic and things like that.
Makes sense. It makes a lot of sense. Joey, I have one last big question here. How did you originally get interested in blogging about macroeconomics, and how did you first get started?
Well, it was like, I think the first thing I wrote was June of 2021. So this was like peak pandemic boredom. So for me, before the pandemic, I was a Peace Corps volunteer. So I was working abroad in Uganda. Then I got bounced back to the U.S. and I think there was a lot of people. You were unemployed. I didn't have a place to live at that time, so you're like, okay, I got to get all my ducks in order. I got to get a job. Got to get, a place to live.
Yeah.
At that point, I had all the ducks in order, and they were in order for like 6 months. And so now boredom was setting in, and I was like realizing, I have things I'd like to say or things I'd like to share about the economy, and so that's when I started publicly trying to share those things. And I think writing and blogging is great as like an iterative process.
Right.
You're writing, people are commenting or criticizing, and you're updating what you write, or you're, getting better at how you communicate, things like that. And shifting the things that you're interested in, all that good stuff. And so over time, I just tried to keep myself, at first like one a week. Then I eventually started doing like more frequent stuff. And then it hit a point where I was like, okay, I have a lot to say. I don't have unlimited time to say it, especially when I'm working a full-time job.
Yeah.
And I had the great privilege of like having people who truly care and were willing to listen and were interested in the same kind of random nonsense that I'm interested in. So I was like, okay, this is, the time to do it. If I was just thinking like, okay, if I don't do it now, there's going to be all these things I want to say that I'm never going to get the chance to say.
Right.
So I got to at least try it. And I've been very humbled by the response, since I started doing this full time.
I love it.
And I'm very happy now to be able to put out more interesting stuff, to do like the kind of really in-depth research that I couldn't do when my time budget was 10 hours a week.
Right.
And I'm really enjoying, just opportunities to be able to speak with people, things like this, where you get to have an interesting back and forth.
I love it. I love it. Well, Joey, what's the next 10 years look like for you? Have you thought about it much?
Oh boy. It's funny because the personal forecasting record is 0 out of 10. Never gotten anything right. So if you go back at any point in the last 5 years and tell me where do you see yourself in 2 years, I would have gotten it wrong. So I am trying to take things one day at a time. I think the benefit of writing is you have a community of people who care about the same kind of things that you do. And so, I'm planning to take the writing stuff as far as I can go with it, but I'm also aware that there might be a time and a place where I want to do something else interesting. And I have the very great privilege of having this platform that I can use in that pursuit. But yeah, right now I'm just writing.
It's great. It's great. It's a real superpower to have a community like that. Well, Joey, thanks so much for coming on the show. Where can people find you? Where should we send them?
So I am on Twitter most of the time. It's just at Joseph Politano, or Joey Politano is the actual username. I write a newsletter. It's Apricitas.io is the name of my Substack. It's a K sound, but it is a C letter because that's how Latin works. So it's Apricitas.io.
Good deal.
And that's where all my writing is. You can also bother me on LinkedIn. I don't know.
I love it. And I highly recommend the blog. It's really excellent. Thanks so much, Joey. Really appreciate it.
Yeah, really happy to be on. Thanks for having me.
Definitely.